This is one of my favorite lessons for people who want to understand early stage investing. And we have to understand that the opening up of public venture capital can really change the game. And we're going to understand how and why by looking at Beyond Meat, which was funded first with all these rounds of private capital, and then that was followed on with the IPO, which gave them a round of public capital. So let's look. We're gonna follow this along from the first recorded valuation here. So they had a Series A. That's considered a venture capital round. Usually, a company like Beyond Meat, starting, we're talking about 2011, so that's 10 years ago. Their first valued round, valued at $4.8 million for the whole enterprise, the whole market cap, you might say. And their market was basically high net worth investors and venture capital funds, ultra high net worth investors and VC funds. Because you have to understand that a round like that is going to be limited to 100 investors. So, not easy to find average people who can write a check. 2 million divided by 100 is 20,000. So that would be, if they did 100 investors, which they probably didn't, it was probably a handful of VC firms. Anyway, the round before this would have been, friends and family round, maybe an angel capital round that wasn't necessarily valued. But so this information is tracking the venture capital grade rounds where they've kind of got their act together and the money's starting to come in. So we're going to follow this valuation along. So 4.8 million, and then now it goes up nearly threefold from one round to the next in terms of valuation. And here they raised $5 million. So they raised 2.5 times the money, but at a 3 times valuation. So percentage-wise, they're not really, as the company grows in value, they can raise more money without diluting the ownership that much. And that's part of the trick of capitalization, is that both the investors and the founders want to balance the dilution so that the company can be well managed. And so there's a certain kind of a logic and fairness to it. So now they're up to nearly 50 million. That's greater than a 3 times gain. This round was valued at 100 million, so a little bit less than double from the prior round. Here's a round that's nearly 3 times the size of the previous one. And you can just see it's getting bigger and bigger, the valuation with each successive round. And so what's really going on here, this is their last private round. So they raised $50 million at a $1.4 billion valuation. So let's take a let's quickly see the valuation gains between the first valued round and the round before they IPO'd. So we'll take 1.41 billion. So that's, and we're going to divide that by 4.8 million. And what do we get there? So already a 294 times gain. All right, 294 times gain from here to there. For the people that took the most risk, right? They had the most to lose. And here you can see the valuation is starting to skyrocket because now the IPO is basically inevitable. You're getting famous people, movie stars, and people are kind of getting the scene. These movie stars are giving you the signal this is going to IPO, and so now the general public is getting excited because the general public doesn't have the opportunity to invest. All the liquidity is tied up in the NASDAQ, the NASDAQ and the New York Stock Exchange have a monopoly on liquidity. So these later investors here, they know they're going to get a huge premium between the last private round and the first public round. So that's why these are big money players. They want a high gain at a low risk, where the people down here in the Series A, they're taking a high risk, and they are going to make an even huger gain than the later ones. But it's hard to find large pools of capital that want to take risk, and this is one of the reasons that we can't seem to solve large-scale problems, because that risk, really, that high risk, we need a lot of money to solve a lot of problems in the world. That risk has to be distributed very broadly. So that's why Vegan Launch is focused on public venture capital, because that way we can raise millions and millions of dollars with no one investor taking an undue risk on their portfolio. And that's what we need, if we're going to really start the kinds of companies that can totally change culture, solve climate change, remedy the $7 trillion a year that are wasted on chronic illness. All those kind of things are going to take massive capital. And the VC firms, they're investing money from pension funds, endowments, and the family offices. They're very risk averse. So the idea that you're going to get huge checks from when I say lots and lots of huge checks, even the wealthiest individuals in our culture, people like Jeff Bezos or Bill Gates, they can do a lot, but their net worth pales compared to the green sector investors with 30 trillion, or the sub-niche of that, the vegans with 3 trillion. If we can work together as a community, we can do a lot more than any one of these individual wealthy people, and that's what Vegan Launch is all about. So now let's look and see what happens on the public side here. So we're going to go look at Beyond Meat's public trading record. And so here we're basically starting from day one, and their current valuation is just a hair under $7 billion. But if we look at this chart, we can see the stock price from day one is on day one it started trading at 66.79. So that's the first time a rank and file investor could get in. And today it's only trading at 110. So there's been some ups, there's been some downs, but that's not even a twofold gain. We're talking April, so it's 2.5 years since they went public, and if you bought and hold on day one, you haven't even doubled your money. So that's a far cry from what was going on in the private round. So let's do those numbers again. Let's look at our calculator, and now we're going to clear this. We're going to do a $7 billion current valuation, so 7 and a lot of zeros. And we're going to divide that by the first valued round, which again was 4.8 million. And let's see what that comes out with. Okay, so sorry about all the decimal points, but we're talking about a 1,458 times gain. So $1 invested in the Series A is worth $1,458 today. So this is why people who can invest in early stage. Now, I don't want to get all glossy about that. Just because now we, the people, can get together and finance startups, that doesn't necessarily mean that we're going to get those kind of gains. But what we will do with also the liquidity boom, which means that we will be having in the companies that we invest in, if they are successful, that we invest in as a community, shall we say, the liquidity. See, right now, these investors are getting basically a liquidity reward because of the price differential between the private rounds and the public. It's like it's the same as wholesale and retail at any kind of store like Walmart, right? If you go to Walmart, you buy a shaver there or something, you're paying double or more what they paid at wholesale. So there's a built-in bump between. This is really about distribution of investment products. With the vegan launch model now, we're essentially cutting out the middleman. The distribution is direct from the founders to the general public. So that doesn't mean the gains aren't there, but that liquidity bump will be more evenly distributed. So in the end, the valuation is the valuation. When something is public and in a highly liquid market, that's a pretty good, the more liquid the market, the more, shall we say, true the valuation is. And because of now the liquidity boom and intermediate markets or secondary markets, people who invest in public venture capital will have increasing opportunities for liquidity. So that liquidity premium is going to move from the private investors. It'll be distributed more evenly across the curve. But let's face it, a successful company or a failing company, we can't get a lot of money out of a failing company. It's just not going to grow that much. One day or another, the raw facts will come out. But what this does mean is that because we're smoothing out the liquidity boom and we're going right to retail, now we can do projects like the investors here are trying to make huge gains, 1,000, 2,000 fold. The round one investors in Uber made 20,000 fold returns when the company went public. So here, and these kind of investors demand those kind of gains, where the public, you can see the public is saying, well, okay, we're going to take less than 2x earnings on Beyond Meat over a 2.5-year period, less than twofold returns, in the hopes that it'll do something and maybe give us 10x or 20x, or, if it's a real, huge success, maybe 50x over a 10-year period. And, so the problem with the public market is it's mostly wealth conservation, people trying to avoid the devastation of inflation, right? So it's hard to get a lot of growth. If a company is valued at $7 billion, well, for it to double, that means the market cap would have to go to $14 billion. So that's a lot of growth. That's a huge amount of growth, where moving the growth needle from a company that's got, $300,000 of sales or $500,000 of sales or even less, moving that needle is really pretty easy. So by distributing the risk broadly, we're giving more and more people the opportunity to come together, do projects of scale, do projects that don't necessarily have to have kind of a forced growth curve to satisfy the wholesale investors. I mean, imagine if Walmart said, well, we're only going to make 5% when we buy wholesale on our electric shaver and sell it. They just wouldn't do it, right? And that's things. So the VCs are not going to invest in companies where that growth opportunity is, that huge growth is a potential. But with our strategy, we can invest in things like one restaurant, anywhere in the world. We don't need to get a grand slam out of every single investment. We don't have to even go for that necessarily. But by being totally inclusive in the kinds of companies we want to finance, we've already seen this. There have been some amazing, unicorn potential companies that have come through our deal pipeline. But the problem we had with investing in them is, frankly, the investors weren't ready to act. They weren't educated, and they couldn't see what I saw. It's like, man, this is the best deal I've ever seen coming through, where we had the opportunity to invest right alongside with some, A-grade Silicon Valley venture capital firms in the first round of a company that is let's just say, very much like Beyond Meat in a way. And that's really all I can say publicly about it. So if we're in the mix, we'll, as a community, have the opportunity to invest in these unicorns alongside VC firms. VC firms can invest alongside us. We have strategies for VC firms. If they use public capitalization wisely, they can also lower their risk and increase their upside relative to the performance of a company. So this is so much of an important lesson, and I'm just really glad to be sharing this information with you. And I look forward to any comments or questions, and we'll answer all of them. Thanks very much.